that Simon's not here tonight because this obviously reacts badly to a lot of weight. There will be a lot of noise. So I think I'm better prepared at this stage.
Do you want to slip through one of the cracks?
I'm going to slip one of those. Simon might just go through it. Anyway, I'm going to approach this really two ways today. Tax is just another cost of the business, and really should be trying to minimise it. So I'm going to look at it really trying to reduce the company tax bill and some ideas about that. But also, once you've got to that stage, you reduce the tax and hopefully your profits have gone up, how to try and extract that cash tax efficiently as possible. Now, tax is not like any other cost that Mark might have been discussing where there's benefits from it, unless you're like Warren Buffett and you feel that paying tax is a good thing for altruistic reasons. We always think tax is just another cost, and that's what we want to really work on. Be pleased to know you're not alone. The government is helping, honestly, to try and reduce your tax bill. And there are 5 ways, really, that they've introduced recently which help with that. Obviously, corporation tax rates are coming down. They're going to come down to 23% by 2014, and that will make the UK's corporate tax rate the lowest in the G7 when that comes through. So that really is a very useful future that we're looking forward to. Secondly, the government have introduced some branch tax exemptions. So if you work overseas, you've got overseas branches, then up to now you've always been able to offset any foreign tax that you've paid against your UK tax profits, but always only up to the level of UK tax. But from April 2011, you can elect to have your foreign branch profits totally exempt from UK tax. Now, it's not quite as straightforward as that, because if there have been losses in the past and you set those off against your UK profits, then there's a clawback mechanism. But that's an idea that is going to be potentially very useful in the future. And we mustn't forget the substantial share funds exemption, which has been around for a few years now. But once you're aware of it, it does help you how you structure your profits. It does take out a whole tranche of tax potentially if you're looking at selling a trading subsidiary. The rules are relatively straightforward. As long as you own 10% of your subsidiary and you've owned it for at least 12 months, and the group is a trading group before and trading group after, then you can sell your trading subsidiary totally corporate tax free, so it takes away that potential double tax charge. So if you are thinking of selling your subsidiaries in the future, then it's always worth checking those rules well in advance so that you can groom as necessary. Now, we love research and development tax credits, and they've been enhanced in the last budget, and it's something that we always try and look at with companies. A lot of people think, well, it's not going to be relevant to me. They talk about white coats in laboratories. But actually, the definition of research and development is as long as you're resolving some scientific or technological uncertainty, if you've got a problem and you sort it out and no one else has been able to sort out that problem, then you would qualify for research and development. And the revenue are actually, they've set up specialist centres around the country which will help you actually do that, and they're very good. They actually come out and try and understand the business. So if you can qualify, then the additional credit that you're going to get is 75% of your cost, and that's going up to 100% from April 11 and up to 125% from April 12, and the EU have now just approved this because this is state aid, obviously, so the EU has approved it. And as an example, if you've got a company with £200,000 worth of profits and the spending on R&D is 75,000, and the minimum is 10,000, so you've always got to get above that threshold. But in this case, it's 75,000. You're getting a tax relief with the 75,000 against your profits. The R&D is going to now give you another 75,000 as a credit against your profits to bring down your taxable profit to 125,000. And you pay tax on that, so you're getting double your money. It is free money, and it's surprising how much of this which is involved in the new car design and manufacturing. And they set out with some uncertainty about space utilisation. They want to improve that. They wanted to reduce the weight of the cars. They wanted to increase the mileage per gallon. And they looked at all of these uncertainties, and they've come up with a car which can seat 3, which only weighs 550 kilograms and is getting 80 miles per gallon. And then we put in very substantial R&D claims for revenue. They came along, had a tour and discussed it, and they have now agreed that R&D is available for that business, and we're actually getting back just under £1 million worth of tax credits. Not everyone's obviously going to get to that sort of level, but when you've got a new company starting out when cash flow is absolutely vital, then R&D can make a significant difference. Even on these sums, if you're getting £20,000–30,000 worth of tax back. Because if you haven't got profits, you can actually take back against the pay as well. So it really is a very, very useful incentive, which we always try and look at. Now, Mark mentioned in his initiative 5 about maximising value from staff. They are the biggest asset. But it may well be that right now you can't actually afford to pay bonuses or give them incentives. So always look at whether you can use share option schemes, particularly the enterprise management incentives, the EMI scheme, which you've probably all heard about. And that really does give some good tax breaks for the company and for the employee. If you can try and retain your staff and incentivise them by giving them share options, particularly on an exit base, where they can share in the capital value of the company in 3 or 5 years, if that's what your intention is to sell, then potentially you don't need to pay them a bonus. You say, stay with us, work hard, and we can actually give you a share of the cake. And if you can increase the size of that cake, then you don't mind giving it away. As an example, in this case, shop options over 5,000 shares to staff were issued at £1 per share. This is so a share option is a promise to buy shares at some point in the future at a price agreed today. And because it's a tax value that you're agreeing with the revenue, you can actually get a very large discount on your actual commercial value. So in this case, the commercial value of the company was £5 per share. We can agree with the revenue that it's £1 per share because it's a minority, so you can get a minority discount, an 80% discount in this case. And then when the company gets sold 3, 4, 5 years later at 4 times, grown 4 times its value, you can therefore get £100,000 in the employee's hands very tax efficiently because it's assessed the capital gains tax. They've got their annual exemptions. Capital gains tax rate is 28%. Unlikely they're going to qualify for entrepreneurs relief because they won't have held the shares for the 12-month required period. They get the shares immediately before the sale. But if that was an issue, then maybe you can have an exercise point at some point just 12 months before a sale. But in this case, assuming Simon's numbers are right, that's a tax saving of £22,000 for a member of staff. It also saves £12,000 for the company, employers, national insurance. And what a lot of people forget is at the time of the exercise, you can generate a tax deduction for the company equal to the difference in value between the market value of the date of exercise, which will be very close, if not exactly, to the sale price, so in this case £100,000, less what they pay for the shares, in this case £5,000, gives a tax deduction of £95,000, which gives a corporation tax saving of £26,000. And that can be really useful as a trigger on a sale, when you can actually say that to the purchaser, look, there's a further tax deduction here, and therefore you want to try and increase the proceeds for that. So EMIs always be good looked at. Not always good news. The revenue are obviously desperate for tax take at the moment, and they're listed in lots of companies. They're checking records a lot, and the advice really on this one to try and keep your tax costs down, really penalty tax cost, is prepare for that initial meeting. Because the revenue are very, very good at getting in and having a chat and then finding out that you've actually missed various things over a number of years. And we've had examples where we had a new client turn up, and they've actually been paying their pay-as-you-earn late, only by 3, 4, 5 days, but late every month, without really realising it, and it was never being picked up. The revenue came in for a meeting, went back 5 years and realised that, and before they knew it, there was a £100,000 penalty, because it just accrues and expands and becomes very, very difficult, so compounding impact. So if the revenue do say they come to me, do prepare, talk to someone, and if necessary, get your ducks in a row before they're there. Now, you've made a profit, you've minimised the tax, now think about how to extract it tax efficiently. And these are the ideas I just want to talk about. There are 5 or 6 there. Some are fairly standard, and you will consider them. Some, maybe not. Salary and dividend. I think everyone obviously goes down that route, and with the fall in corporation tax rates, particularly as going forward, then almost certainly taking out cash from a company as a dividend, particularly with NIC going up as well, is going to be more tax efficient than taking it out as a salary. We do the number crunching every time just to make absolutely sure. We'd be very surprised if paying salary is more tax efficient now than paying a dividend in any particular circumstances. But do take into account there are other factors that may push you down the route of taking a salary, particularly if you're thinking about pension planning or life cover. always thinking about taking out a mortgage, although hopefully a lot of mortgage providers these days do understand that companies, directors, shareholders do take out income through dividends, but if there's, so you need a specialist mortgage broker on that. But the impact on the bonus pool is an interesting one, because if you are paying bonuses out from your company to start and you're then taking out the money as dividends, your profit figure is almost necessarily higher because you're not taking out a salary, and therefore you'll end up paying more bonus than you potentially expected to. So you do need to make sure when you're drafting your bonus pool that you do have a clause in there which says you can adjust to put market value salary back in there again, otherwise you're going to be paying out much more than you thought to your employees. And thought about, I don't know what someone was thinking about on that one. I imagine it's paying salaries to the family or transferring shares to the family. Certainly paying salaries to the family is absolutely fine, but do make sure that they actually do something. You can justify it, and that you're covering the national minimum wage. It's quite easy normally to justify, even if a relatively small sum, even to children as well, if you can say that particularly we've got a client who writes computer games. One of the directors, one of their children actually comes and provides image rights and tests them and things like that, and we can actually justify a salary for that child, which is all under the personal allowance. That's all tax-free, so it's absolutely fair. Transferring shares to the family. Now the revenue would have you believe that this is an absolute no-no, and the revenue tried to stop it in about 2007, 2008, because it's relatively straightforward planning. You gift the shares to the spouse, and you can make use of their personal allowance and avoid all the higher rates. And the revenue, as I said, tried to introduce legislation 3 or 4 years ago, the income splitting rules. It was so complicated, so unwieldy, and we've created so much aggravation that they've just dropped away from it, and there's nothing there at the moment which actually stops you transferring shares to the other spouse and diverting income that way. You have to make sure that they're full of shares, you don't try and restrict them in terms of capital and income, so they're fully voting. You have to be careful with the circumstances. We've had certain examples where a spouse has transferred shares to the other spouse, and within a week they put, she said she's leaving, and it just caused a few problems. So you have to, in the right circumstances. Pension planning is always very useful, even though the maximum is now £50,000. You can go back 2 years, and if you change your input periods as well, you can potentially get £200,000 into your pension scheme if the circumstances are right, which can be a very useful way of planning. A lot of people say, I'm not interested in using pension schemes, I'm not going to give my money away to the legal and general for them to lose it. But of course you can use your SIPs now, your self-investing personal pension plans. And I know Mark does a lot of planning using SIPs for clients, particularly when there's commercial property, where at the moment they're renting their commercial property. They get funds in their SIPs over a couple of years. It's medium-term planning. Use that as a deposit. The SIP can then borrow, purchase the commercial property, and then the company actually rents it from the SIP, which is then all tax-free, plus you get the corporation tax deduction for the rental. So that's very nice planning. You need to think about it in advance. But over time, that can be very useful. Of course, you can have a husband having a SIP and a wife having a SIP, so you can, again, double up all of these sort of potential planning ideas. Ever considered taking a loan from a company? And of course that was legal up to 2007 under the Companies Act. The Companies Act has changed from that date. So as long as you now put the paperwork in place and get approval of the shareholders, there's nothing to stop a private company giving a loan to one of the shareholders. Mainly because there's no tax charge on the loan apart from the beneficial interest. If it's tax-free, then the only tax charge is going to be the beneficial interest rate, which is at 4% at the moment. So the tax charge is on that. So even at 50%, that gives you an effective tax rate of 2% per annum on the loan account. And then you can repay it, perhaps when income tax rates come down from 50%, and you vote out the dividend to clear it out at 25% rather than 36%. The company does have to pay 25% of the loan to the revenue if the loan is unpaid within 9 months after the year end, but that does come back as soon as the loan is repaid by the shareholder or the director. So as long as the cash flow is okay on that, then that's quite a useful way, particularly if you need cash now, you don't want to crystallise a tax charge now. That's not to be dismissed anymore. Something more aggressive, potentially. I mean, you probably all heard down at the golf club and someone's come and said, I don't pay any corporation tax, I don't pay any income tax, and I extract all my cash out and everything's particularly good. Well, There are a number of promoters out there who have got some very aggressive tax planning schemes. We are well aware of what they are. We look at them closely and check out the promoters, the providers of these schemes, because this is relevant for a number of clients. Notice, particularly as income tax rates have gone to 50%, national insurance has gone up to 13–14%, that there is more interest in this. It's actually kind of perverse. The government don't seem to get an increased tax rate. People who are prepared to do more aggressive tax planning. The revenue trying to blur the edges. This is tax avoidance as compared to tax evasion. Tax evasion is illegal. Tax avoidance is within the law, within the letter of the law. It might be against the spirit of the law, but I'm not here to talk about the ethics of whether or not this tax planning is right. But if clients are interested, then we can introduce them to providers of these schemes. And some of these, the planning is technically very, very strong, and at the moment the revenue are struggling to do anything about it because they have to work within the law as well. There's a lot of hot air out there at the moment from the revenue saying they will tackle these schemes and try and do anything. They're in all sorts of trouble, which is absolutely true. Well, you're not going to get an MD if you do one of these schemes. You will be able to sleep at night because you will get plenty of inquiries from the revenue. But as things stand, a lot of these schemes do technically work. You will be in the mire for 2, 3, 4 years as they go through. But the promoters are wise to that now, and they're providing, one company we work with is now providing insurance for the scheme, so that if it doesn't work, the insurance will kick in and repay all of your fees. So you're actually going back to the position you would have been in. There shouldn't be any question of penalties because everything's fully disclosed to the revenue. Nothing's underhand, it's all above board. So that's interesting for those who are of that mind. Now, that's one way of doing it, is to be aggressive and get highly involved. The other way is to be slightly lazy about it and actually do nothing, and actually leave the cash in the business. And sometimes that can be the best type of planning if you are actually thinking of selling the company in the next 2 or 3 years. And let the cash sit in it, don't extract it, don't crystallise a tax charge at 36, 50%. Let it sit there and sell the cash as part of the business. You're going to get extra proceeds for it, and crystallise it at 10%. And that might be the best planning for you. Now, you have to be careful, as always, because you don't want to convert a trading company into an investment company by having too much cash in there. But the revenues, it's not the law, it's their interpretation, is that as long as the cash is less than 20% of the overall value of the company, and is deemed not to be significant, and there are other factors as well, then that doesn't affect your ability to get entrepreneurs relief. So you can still be treated as a trading company even though you've got a lot of cash in the balance sheet. So, that's a summary. There's no getting away from it. Tax is always going to be there, but it is a cost. You really must try and minimise it and manage it effectively. There's no easy answer. It's really using some imagination when talking to the clients, but actually talking to the clients, understanding what their needs are and where they want to be in 2 or 3 years' time, and just discussing the various options open and getting to know them. Right. Thanks very much, Simon.